Okay. I'd like to welcome everybody to this regular meeting of the CERS Investment Committee. As I said, this is a regular meeting, not a special called meeting for a change. Eric, do you mind to give us our opening statement, please?
I'm here in place of Eric today.
I'm sorry, Colin.
All right. This is a regular meeting of the County Employees Retirement System Board of Trustees Investment Committee. This meeting is being broadcast via video teleconference pursuant to KRS 61.826 and may be viewed by the public at the Kentucky Public Pensions Authority offices located at 1260 Louisville Road in Frankfort, Kentucky. It is also being broadcast to the public live via Facebook. If you are speaking and not appearing by video, please identify yourself before talking. If the video or audio broadcast is interrupted, we will attempt to reestablish a connection. If a connection cannot be reestablished within 30 minutes, the meeting will be adjourned and rescheduled to a later date.
Okay, thanks, Colin. All right, Sandy, do you mind take the roll, please?
Certainly. Dr. Hackbart? Mr. Cheatham?
Here.
Dr. Milkman? Mr. O'Mara?
Here.
And Mr. McGraw?
Here.
Okay, being a quorum present, we'll go ahead and proceed. I understand we do not have any public comment. Is that correct?
That's correct.
All right, thank you. We have, looks like 4 sets of minutes that were in your packet. I'd like to go through and get approval for those. The first set of minutes were for the February 26th meeting. Are there any changes, additions, or deletions that need to be made?
Approve as submitted.
Got a motion to approve as submitted. Do I have a second?
I second that.
Second by Tommy.
Yes, sir.
Any other discussion? All in favor signify by saying aye.
Aye.
All opposed? Ayes have it. Minutes for February 26th are passed as presented. The next set of minutes are for March the 26th. Are there any changes, additions, or deletions that need to be made to this set of minutes? Hearing none, I'll entertain a motion. Motion by Bill.
Second.
Second by Tommy. All in favor signify by saying aye.
Aye.
All opposed? Ayes have it. Minutes are accepted as presented. Then we have the April 30th, 2025 set of minutes. Are there any changes, additions, or deletions to these minutes?
I again submit approval.
Bill, got a motion by Bill and second, I think, by Tommy. All
Yes,
in
sir.
favor signify by saying aye.
Aye.
All opposed? Ayes have it. And the last set of minutes is for May the 13th. Are there any changes, additions, or deletions that need to be made here?
Move approval.
Got
Second.
a motion, second by Mr. McGraw. All in favor signify by saying aye.
Aye.
All opposed? Ayes have it. All minutes are now accepted as presented. The next item on the agenda is the CERS Quarterly Investment Review and Update. Mr. Willer, would you like to take it from here?
Yes, thank you. Good afternoon, everyone. I think we're going to start off, and Wilshire's going to provide an overview of the economic and market backdrop for the first quarter of 2025, the third fiscal quarter of 2025.
Thank you, Steve. That sounds good. And Chris and I are here coming at you from your boardroom today, so you can see us on the owl instead of in our square. I'll do the first part of this and just talk a little bit about the first quarter. First of all, the first thing I'll say is this really stale information at this point, March 31, but it's going to tie to the performance that Steve will go through shortly. But I'll just talk a little bit about that quarter, and then since that quarter ended, and interestingly, the first quarter, as we started to sell off in the U.S. equity market, the U.S. equity market peaked on February 19th, started to sell off. A lot of concern in the marketplace, and interestingly, it became one of the first quarters in a while, and one of the few quarters in the last 10 years where diversification really proved itself, and that a simple 60-40 portfolio of U.S. stocks and bonds did about the worst compared to anything that was more diversified, such as your fund. So a good story for that, good enough that we put out a brief piece on that, about a page and a half, just to talk about this is one of those quarters where diversification helped. So interesting, and also note that all of this sort of noise we had in the marketplace was essentially played out in the U.S. equity market, where during that quarter, the U.S. equity market was strongly negative. Chris will go over some of the specifics on that, but many other asset classes performed well. Non-U.S. markets performed well. A lot of kind of firsts there, in that we've got non-U.S. markets finally outperforming. We have the U.S. dollar was a bit weaker, so a lot of these things led to diversified portfolios doing much better during that quarter. Since March 31, as the U.S. market peaked on February 19, the S&P bottomed out at about down 20. So we were like sort of knocking right on the door of bear market territory, down 20% around the time of all the Liberation Day and everything in early April. And then a strong snapback. The U.S. equity market from March 31 through yesterday is a positive 6%. So this quarter, up 6%. And it's only about 4% off of what was that peak on February 19. So tons of volatility that we've all been faced with. It has also recovered to positive territory on a year-to-date measure. So that's the U.S. equity market, and that's where the noise has really been. So many other things, non-U.S. markets through yesterday, so I know that's stepping beyond this quarterly report, but just to give you a sense of the market now, non-U.S. markets are up 14% year-to-date. So the U.S. equity market's about flat after having gone through what it's gone through. And we're not saying anything's over about that either, but that's where we've been. But non-U.S. markets are up 14% year-to-date. Bonds are up 1.2% year-to-date. Anything in the real asset category is doing quite well. So you have a lot of these things in your portfolio that are diversified from just the traditional U.S. equity market or a traditional 60-40 portfolio. And the reason I reference that so much is that for much of the time, all the way back to 2008, the end of the credit crisis, a 60-40 portfolio has done really well. And so, many of our clients like you that are well diversified, broadly diversified, haven't always been keeping up with those 60-40 portfolios that kind of rely on basically, two things, U.S. equities and U.S. bonds. So that's an unprecedented amount of time for that to play out, but it has. And when we get these periods with a lot of volatility, you'll see that the other assets you have are really helping to hold up the portfolio. So that's a bit about, just kind of to date. A couple of pages in the report that I'll go to, page 24, shows the rate environment, and I'll just, to give you, I think, more of a sense of volatility, that top chart, the top part of that chart is the 10-year Treasury nominal, and you can see up and down and up and down, and that's what we've been through. On the 10-year, peaked out in the high fours. We're about 4.5 right now, and so this, like stocks, the 10-year reacts quite a bit to what's going on in the marketplace. What everyone is thinking in aggregate about the things that we can't control, which are tariffs, the tax bill, deregulation, all the things that the administration is working on, present plenty of volatility and not things that we can predict, other than knowing that, yes, these all have impact on the market. And so I think the best message for all of you with your fund is to stay the course. And I think when Steve goes through numbers, that'll show that that's been proving out for you. So that's a picture of rates. A couple of other things 20 over to 27, the top chart is real GDP growth. We just had, so this ends at the fourth quarter. The last measure that being of the fourth quarter was 2.4% positive. So you see a nice string of positive GDP growth there on that chart. We just had the first negative quarter, negative 30 basis points. I'm sure most of you have been able to follow that. And, whether we have a second quarter, then potentially you get one of the technical measures that tries to claim that that's a recession. I think bigger picture is we believe we're in somewhat of a slower growth environment, but whether we get 2 quarters in a row that give us potentially a technical definition of a recession, it's also really not the official definition of a recession, which the Economic Bureau of Research will come out and tell us if we've had a recession when it's past tense. So not to be worried about that, but just to say growth certainly was impacted with all that happened during this first quarter, and so we got a negative 30 basis point measure on that. The other final thing I'll go to on this first part is page 28, consumer activity. That this is interesting. We talk about this a lot in our meetings, in that consumer sentiment, consumer spending drives 70% of GDP. So what the consumer is doing matters, and what the consumer is thinking matters, because what the consumer is thinking tends to then result in what they do next. And consumer sentiment until yesterday has really been a bit challenged, and that's one of the things when you look historically, when consumers get concerned about what's coming, it's almost like it's somewhat self-fulfilling, because they start to button down a bit and spend less, and then what happens? We have slower growth. So interestingly, yesterday we had a huge spike positive in consumer sentiment, well up over 90% compared to estimates that were in the 80s. This was just a really strong measure. And I think, I don't know that I'd write home a whole lot with that, but it's a reflection of the market in aggregate. As you read all kinds of different things, the market is starting to say, well, maybe we've got a lot of this tariff stuff figured out and all the other things that are on the table. Hard to say. But that said, the market has rallied, and it's recovered almost to its high, and here we sit deep into May. So that's just some of the high level general economic activity. Chris will take us through some returns that will start to set the stage for the first quarter of performance
Thanks,
review.
Tim. If we go to slide 31, we'll just do a review of U.S. markets to start with. And first quarter was defined by as defined by the FT Wilshire 5000, was down almost 5%. Large caps continued to outperform small caps. You see large cap was down about 4.5%. Small caps were down just over 6.5%. Saw a little bit of a reversal in the growth versus value trade. Large cap growth was down over 10%, while large cap value was actually up 2.2%. So you saw a little bit of a reversal of what we had seen for so many quarters previously. Same thing happening in small growth down almost 9%, small value down about 4.5%. That was really driven by the IT and consumer discretionary, where those two sectors were down double digits. IT was down almost 13%, and consumer discretionary was down over 13% for the quarter. Whereas the two sectors that kind of rallied or outperformed were more on that value side, the financials and the utility sector. So again, seeing that value versus growth reversal there. Still though, on those two right charts, if we look at the rolling 3-year between large cap versus small cap, you can see on a rolling 3-year basis, the large cap still continues to outperform small cap by over 5%, and growth is still outperforming value on a rolling 3-year basis by just under 5%. If we move to slide 35 and start looking at the non-US markets, as David said, going into March, everybody was talking about tariffs and Liberation Day. That led to a lot of the underperformance in the U.S. equity markets. A little bit different story on the non-U.S. equity markets, right? They had to look at themselves and try to determine how they were going to deal with all these pending tariffs. The ACWI ex-U.S. gross was actually up 5.4%, led by the developed world, up 7% for the quarter. EM was still positive at 3%, and the ACWI ex-U.S. value actually outperformed the growth by about 6%. It was up at 8 versus 2% on the value versus growth. I think what's really interesting is if you look at the All Country World Index, with all that volatility, all the T word tariff being thrown around, equity markets were only down about 1% over the quarter. So to David's point again, if you were diversified, if you held U.S. equity, non-U.S. equity, bonds, real assets, the diversified portfolio in all that uncertainty really held up in a very volatile period. And if you had been positioned more defensively, if you had a min-vol strategy on, that actually outperformed by about 6%. That gave you an absolute return of 6% over that quarter. So really, it was a risk-off quarter for equity positions. But overall, again, diversity paid off here. If we go to the next slide, you can see the U.S. fixed income market. The yield curve, as represented in the lower right-hand corner, the light blue line was where we stood as of fourth quarter, and the dark blue line is where the yield curve stood as of the end of first quarter 2025. You can see that the yield curve shift down across all maturities, specifically shifted down a little bit further in the shorter term duration, and that really was an outperforming factor for your bonds. So the aggregate outperformed by didn't outperform, but gave you about a 3% return, as did Treasury over the quarter. Corporates with spreads tightening were a little bit under that, just about 2% for the quarter. But TIPS was really kind of the outperforming sector, if you will, here. Again, inflation was still a concern during the quarter, 4.2% return from TIPS. And again, high yield, kind of along with the corporate there with spread compression, only had about a 1% return for the quarter. If we go to slide 41, this is the heat map that we tend to like to represent here. And I just want to draw your attention to the last column of the first box there, which is really the 2025 year-to-date or the quarter. You can see everything is kind of turned upside down a little bit, where U.S. equity had been the leader for 2023 and 24 was now at the bottom with a negative 4.8% return. Commodities had led the way, just under 9%. Developed U.S. equity, which we saw had a nice pop in the first quarter, was second at 7%. And then you see how the diversification across the different asset classes really played out here. So having exposure to commodities or TIPS, what we call real assets, was really a benefit to the portfolio. Core bonds had a nice quarter at just under 3%. Everything essentially was up except for U.S. equity. So again, having that diversified portfolio really paid off in the long run here. If you look at the far right-hand corner, annualized 5-year returns, U.S. equity continues to lead the way, as David alluded to with some of the stats he provided. All of this data is so stale as of first quarter, leading into Liberation Day. We all felt the pain there in early April. But since Liberation Day, we have essentially not only recovered the losses, but we've moved again beyond those losses. So really, kind of a stale look back at the first quarter, but if you kind of can reset your financial mind and put that hat on again to what it was like in the first quarter, there was a lot of volatility. Diversification did pay off, and that diversified portfolio was really, kind of the ballast for most people that were, looking at things and realizing that U.S. equity was down, but their portfolio really was weathering the storm. With that, we're happy to take any questions.
One question on the global equity realm. To what extent is the weakness in the dollar that we've seen play a part in that return?
It certainly did. In fact, if you go to page 38, this is a fixed income page, but you can see the returns of currencies versus the dollar at the bottom of this top chart, the last 3 lines. For the quarter, The euro ahead of the dollar 4.5%, yen versus the dollar 4.8, pound 3.2. So absolutely, Lyle, those all had impact on the return of non-U.S. markets to the U.S. investor.
What's your all's expectation there going forward as far as, do we still see that kind of benefit in a weaker dollar to us, or is that played out at this point?
Yeah, it's in the short term, we feel that we can't predict in the short term because it's tied to so many things, and particularly the things that we can't really predict right now with what's happening with global trade in general. That's going to impact the dollar and other currencies. What's happening with our deficit and demand for long-term debt out of the U.S., which has always been a mainstay. So, in some sense, we've talked internally about it's kind of like equity markets selling off. The dollar's had a strong run. Like there's a level of this that some reversion to the mean can make some sense. And the longest of scenarios, we believe economically in purchasing power parity, meaning that currencies will, over time, deliver the same kind of returns if you just look at currency returns. But that over time message can be really stretched out sometimes. So just the point to say is we don't have a forecast on where the dollar goes in the short term. We recognize that it's been strong and we understand its recent weakness, but it's tied to a lot of bigger issues, I think. And in the meantime, but it kind of comes back to the whole point of diversification, because non-U.S. investing, there's the currency component, and then there's actually the opportunity set of all those other investments into public markets that trade outside of the U.S. and similarly in private markets, investments outside the U.S. So you have a more diverse set of investment opportunity, and then you have currency as well becomes a component of that diversification.
Well, it appears we're building up some cash. Where do you all see the top 2 or 3 opportunities for allocation at this point going forward?
Go ahead, Chris.
Well, I was going to say, through our investment strategy committee, we usually reflect where we see opportunities in the way of pair trades. And in this world of uncertainty, we've actually even ratcheted in some of our quote unquote tactical positions a bit more. So we're not seeing a huge amount of obvious opportunity right now. I will say, if I can remember, I'm going back to some of our ISC slides. In the first quarter, we really liked government related as opposed to credit.
Yeah.
We felt credit spreads were pretty tight at the time, but now that you see credit, the spreads are starting to widen out a little bit. There could be some opportunity there. But again, we're really talking to most of our clients right now about sticking with their strategic asset allocation, because through that strategic asset allocation, you've really, presented a risk appetite, and absent of a compelling opportunity, we really think you should be sticking very closely to that strategic asset allocation right now.
I do have one question. That's all I'm going to ask today. With the administration's dealings with India and Pakistan, do we see that slowing down the BRICS nations, or do you believe they're still going to push forward?
Push forward, and how do you mean by push forward?
Well, of course, they're wanting to create a new currency for trading oil. That was the whole strategic thought behind the BRICS nations, was something to replace the dollar. And of course, we all know if something like that goes on, our dollar will be worthless. But I mean, just out of curiosity, my thought was, especially since the administration's relationship with India now, I would, with India being a big part of those BRICS nations, I just wonder if that might slow that movement down or what going forward.
Yeah, that, you know, it's another one in the category of very hard to predict. I will say we're not seeing the dollar as, as being replaced near term, but there's so much geopolitics behind all of this that it goes beyond econometrics in some senses. So, but it's not something that's at the moment keeping us up at night.
Got you. I just wondered. I know no one's got a crystal ball, but
Yeah.
just wondered what your thought was on it. Thank you.
Mm-hmm. Sure.
Hey, anybody else have questions for Wilshire? Okay. Steve, you want to?
Sure. Thank you. Page 44, please. Good starting point. And Wilshire provided a good overview of the economic and market backdrop during the quarter, plus a little insight into some of the things that have happened since then. And I think it's good to step back. And as they mentioned, the weakness in public equities, especially U.S. public equities over the course of the quarter, it's hard to remember that, in fact, January was a very strong up month for U.S. public equity and global public equities that subsequently we sold off significantly in March. So thematically, that volatility that we saw in the first quarter, that's actually extended here into this quarter, and that's our anticipation that the volatility will be a theme in investment markets for the foreseeable future. We'll go through some of the performance and portfolio positioning as of the end of the quarter, which, as Wilshire mentioned, already seems like ancient history. We'll touch on a few of the themes that they talked about since the end of the quarter, and then happy to answer any questions. So on page 44 here, consistent with the overall market backdrop, the portfolios produced modest positive performance during the quarter, speaking again to that diversification element that Wilshire highlighted. And that's primarily as risk markets sold off in March, giving up most of those gains that were achieved at the beginning of the quarter, as that post-election optimism in the U.S. gave way to concerns that policy uncertainty could tip the economy into a recession. We saw that with the initial first quarter GDP print, which will certainly get revised. And as Wilshire mentioned, I think Atlanta GDP Now forecast is looking at a 2.2 currently for this quarter. We always, those determinations of when we enter recessions are always well after the fact. So we'll have to wait some time to see how that plays out. As Wilshire mentioned, we saw the S&P hitting a new record high in mid-February, only to tumble into correction territory. And I think we actually entered correction territory intraday in just 3 weeks. So again, that volatility theme that was with us in the first quarter and has continued in the first 2 months of this quarter. The CERS pension composite produced a return of 44 basis points for the quarter, and the CERS insurance composite produced a return of 33 basis points versus the benchmark return of 37 basis points for the quarter. Individual portfolio performance ranged from 32 basis points to up 45 basis points for the quarter. The core fixed income, real return, and specialty credit portfolios all produced strong absolute performance during the quarter, which was offset by negative performance in public equities, which is obviously the largest allocation in the portfolio. The real return and specialty credit portfolios were the standout relative performers, outperforming their benchmarks by 99 and 128 basis points respectively. Again, goes back to that in times of stress, diversification pays off, which it did during the quarter. Fiscal year to date, the CRS pension composite produced a return of 5%, underperforming the blended benchmark by 22 basis points, while the CRS insurance composite produced a return of 4.71%. Turn to page 46, please. This is that new report that we rolled out a couple of quarters ago, and it's the internal performance. And it reports for all of the internally managed portfolios at the trust level. Not all portfolios are invested in all of these internal portfolios. As a reminder, the majority of these assets are passively managed and intended to replicate the return and risk of public indices, providing inexpensive beta exposure to more efficient markets, while providing staff flexibility and rebalancing the overall portfolio asset and risk allocations. Additionally, staff manages a number of proxy portfolios to gain exposure to assets with similar risk, return, and economic characteristics. that serve as transitional positions for these less liquid asset classes as committed capital is called by managers and staff sources new investment opportunities. I would highlight the significant outperformance of the scientific beta portfolio relative to its index, producing 541 basis points of alpha during the quarter. That goes back to the discussion of U.S. Public equity markets that Wilshire had. And while the market dynamics have not favored the style of this factor-based portfolio over the last several years, as Joe will discuss, the portfolio benefited from the turbulence in equity markets during the quarter. Additionally, the internal core fixed income portfolio performed in line with expectations, producing index-like performance during the quarter with modest outperformance fiscal year to date. Page 47, please. Another of the newer investment performance reports. This is the asset class performance. And while that prior report showed asset class performance at the trust level, these reports show asset class performance at the individual portfolio level. I would remind everyone that, as we previously discussed, these reports from BNY are currently only able to show gross level performance. We are working on a project with BNY to provide this information on a net of fees basis and hope to be able to roll that out soon. I would also note that while not reflected on this report, BNY has been able to modify the report to better align with the asset categories similar to those in the IPS. In this report, the alternative investment includes private equity and real return, while the fixed income category includes core fixed income and specialty credit. I would note the dispersion of asset class performance between portfolios is relatively tight, with modest differences based on the specific allocation of each portfolio to both the underlying mandates as well as the individual asset classes. And also that other category, which is a BNY catch-all category used to account for administrative fees and expenses. With that, I'll turn it over to Joe to talk about the public equity markets during the first quarter.
Good afternoon. I feel like Wilshire and Steve both have talked a lot about it, so I'll go relatively quickly so as to not repeat too much. But if you recall, coming out of the end of 2024, the markets were rallying pretty strong. They were excited primarily, I guess, with the idea of some tax changes potentially and some deregulation, so pretty pro-growth stance. About midway through February, tariff talks started, and that kind of reversed everything. So you saw a significant drop from mid-February through the end of the quarter. Market leadership remained with large caps throughout the quarter. However, there was a strong style reversal. So where we had seen growth really outperform value for some time, value really had its day in the sun and outperformed growth by, I believe, almost 12% for the quarter. All major U.S. indices repriced in response to the perceived risk of these tariffs and what that might do in terms of growth, future growth, and inflation potential. The Mag 7 names, if you recall, really drove a lot of 2024. They got punished in the first quarter as they were pretty much priced to perfection, so their valuation was pretty well stretched. And so any sign of weakness hit them pretty hard. Small caps and then growth again underperformed during the quarter. Chris and I think talked a little bit about international markets and how they performed, but they actually performed really well during the first quarter despite having that tariff discussion kind of looming over them as far as what that might mean for inflation and growth there. They actually experienced significant outperformance versus the U.S. to a little over 9%. This was the strongest relative outperformance in nearly 2 decades for a quarter in international markets. And the strange thing about that is it was really driven by the lower quality names in the international markets as defined by return on equity. So this became a bit of a headwind for active managers because typically we want to invest in those names that are perceived to be higher quality, and those names lagged during the quarter and really have the last 2 quarters. So that's been kind of interesting. Part of that outperformance from the lower quality names is probably tied to a lot of the stimulus that's attached to some of those countries and what they're doing as far as trying to move their markets forward. So in Europe, you saw a lot of discussion around the U.S. NATO stance and what that meant for their defense spending. Germany released a pretty significant stimulus package that was focused on infrastructure and a little bit on climate. In the emerging markets, China actually outperformed during the quarter, and this was in response to some growth turnaround there. That was in response to late 2024 stimulus there. And then as far as our portfolio goes, for the quarter, we outperformed by about 30 basis points of downside protection. This was driven primarily by our tilt towards non-U.S., and so its outperformance of over 9% really helped us. We did well within the context of the U.S. portfolios in terms of stock selection. So I think 6 of the 7 strategies outperformed. Our allocation within the U.S. was relatively neutral, so our tilt towards value was a benefit. Our tilt a little bit smaller was a negative. So overall allocation didn't have a huge amount of effect. Within the non-U.S. side of the portfolio, we underperformed by about 20 basis points, returning about 4.4% on the quarter. That was due to stock selection. It was actually pretty mixed amongst the strategies, though the left tailed just a little bit longer than the right in terms of that. For the 12-month period ending, we were down about 1.2% on the global equity allocation. This was in response to really some allocation tilts. However, if you were to roll forward in the 12-month period to the end of April, we look a lot better. We're down about 15 basis points. So we had a relatively strong April as things kind of looked ugly in the beginning of the month. And as talks of tariff pauses occurred, you saw a pretty strong rally, and we actually performed well during that month. Fiscal year looks pretty good. As far as our where we are, we're outperforming by about 30 basis points end of April. Outside of that, I don't have any real other prepared comments. Happy to take questions. I guess we've talked about the importance of diversification. If I can find the page number for you real quick, maybe 54 real quick. This shows kind of international developed versus U.S. markets. And as you can see, the red bars are when U.S. markets are outperforming, and we've really experienced that the last 10 plus years. But if you look at the greater context over the last 40 years or 50 years, you'll see that U.S. non-U.S. markets have outperformed about the same number of times and to about the same degree from an annualized perspective. And so that's why we believe in the diversification. You see that last blue tail there, that was that significant outperformance of the non-U.S. And so we want to be able to participate when those events occur. And I guess I wanted to call your attention to that, since we talked about the importance of being diversified amongst the different equity regions. But outside of that, I don't have any other things. Happy to discuss whatever.
Steve, can you go back to page 47?
Sure.
And give a little bit more explanation of the other classification.
So the other classification, as you can see, it's exceptionally small, and that is really the BNY catch-all. So it's not tied to any of our specific asset classes, and it's the accrual for fees that BNY is paying. So it's not tied to a specific asset class. I think that return is not actual return. It's kind of the change in the values in that account, which is how they're calculating returns. So I hope that it's cleaned up on the next iteration of this report. As I mentioned, we're going to split out the fixed income. We're going to split out the alternatives so it matches the asset categories. It's similar to what we'll see on the investment budget, kind of that other category that's a catch-all for BNY accounting.
Okay.
And if no other questions, we'll turn it over page 55 to Brian to cover fixed income markets.
Thanks. Actually, Sandy, I'm going to start on page 56. Wilshire team covered 55 pretty well, so I'll just start here. Core fixed income returned 272 basis points for the quarter. 483 basis points fiscal year to date, underperforming the benchmark 6 basis points during the quarter, but outperforming by 2 basis points fiscal year to date. Corporate bonds were the worst performing spread sector, trailing similar duration treasuries by 85 basis points for the quarter, with half of that being in March alone. The credit curve steepened as intermediate and long spreads widened 10 and 17 basis points respectively. April core fixed income return is not final, but early numbers have it up 40 basis points. Page 57. Liquidity. For the quarter, cash returned 108 basis points and 365 basis points fiscal year to date. At the end of March, market had priced in 3 rate cuts for 2025. Currently, the market is now pricing 2 cuts and matching Fed guidance. The consumer one-year inflation expectations jumped to the highest level since 1981 due to tariff uncertainty. However, Chair Powell labeled inflation from tariffs to be transitory. Page 58, specialty credit. Specialty credit portfolio returned just over 2% for the quarter and a little over 7.5% fiscal year to date, outperforming the custom benchmark by 128 basis points and 182 basis points respectively. Softening economic data and forward earnings guidance, along with increasing trade policy uncertainty, resulted in modestly wider high-yield spreads while total returns remained positive. The risk-off tone resulted in decompression with lower quality issues underperforming, with single B and triple C returning 74 basis points and negative 43 basis points respectively. In a reversal of the 3-year trend, fallen angels outpaced rising stars over the quarter, with the largest fallen angel dollar volume since the second quarter of 2020. And again, not finalized yet, but specialty credit April returns look to be up 21 basis points. That's the last page for me, and I'm happy to take any questions.
Brian, I'd be curious to know your thoughts, and Wilshire, feel free to chime in as well. At this point in time, what are your all's thoughts or plans with regard to duration exposure?
Right now, we're neutral at an overall in core fixed income. I think we've seen, consistent with other markets, we've seen elevated volatility. And we typically talk about the 10-year when we talk about where rates are. Obviously, there's specifically a curve too. We had a significant short implemented when we were in that CERP world in anticipation of rising rates. I think it's difficult right now to have a high level of conviction in rates outlook, especially from a point measure. So the 10-year trading in an 80 basis point range, that's a lot of volatility. That's a lot of significant impact without having a tremendously constructive view on taking an active position. I think fixed income is very attractive at an overall level, kind of given this yield and the cushion that we have, whether it's in spread product or in rate product. But I think it's probably too early to take a significant position from a duration perspective. I think if we could potentially look to trade the range, and Brian and I have talked about, if we start to see pressure, we've seen pressure on the long end that partially is due to what we saw from Moody's, and also the fiscal outlook for the U.S. If we start to see increased pressure in that, I think we could start to leg into position from a duration perspective. But I think it's probably too early. I think we probably have some time before we need to be too active there. Happy to. Wilshire can certainly add some color.
Yeah, and I would just echo what Steve said. Looking at the role of duration in the portfolio, obviously when you have, or maybe not obviously, but when you do have market turmoil, duration can be your friend. It can be the ballast in the portfolio. And if you go back to slide 36, we can see that long-term government credit and treasury both outperform the aggregate. So you're looking at about an 80-point differential between the gov credit and the aggregate, which is kind of your core market duration. If we were just to look at government related, it's about 1% over. And then on the treasury side, you got almost 2% extra by having that longer duration. So when there is turmoil and rates do potentially fall, that can be a nice ballast to your portfolio. But I agree with Steve, it's hard to take a hard stance on duration. You don't want to necessarily extend duration over the top because rates are very hard to predict.
Where do you think the sweet spot is?
Generally speaking, I would say the market duration is really kind of your anchoring point.
Yeah, from a curve perspective, I think the intermediate right now is probably. I mean, front end rates obviously, right? Brian just talked about cash return for the quarter, which has been great, and that's Lyle, as you mentioned, I think we've been letting our cash position drift up a little bit, looking for opportunity, and obviously it's not too punitive given the yields on cash instruments at the moment in our liquidity program. The long end's a little bit tougher for me to get a significant amount of conviction around. I think that's got a lot. It trades very differently, and there's a lot of longer term, as we mentioned. That's was more impacted by the rating action by Moody's and less by necessarily active positioning. So I think we've tended to play more in the intermediate part of the curve.
Does that mean 3 to 5 year?
Probably a little bit long. Yeah, probably 3 to 7. 3 to 7 is probably where where we would actively position. Again, we're neutral. We're neutral from a key rate duration perspective. We're neutral from an overall duration perspective. So there's not an active position in the portfolio right now, aside from a little bit we've been letting cash drift up.
Well, how does all that relate to the corporate side of the bond market?
So from an issuance standpoint or from a spread perspective? So Brian, I think had a couple of comments on spread performance.
Now I'm talking about from a return perspective versus risk. What kind of are you with the tariff situation? Whether we're in a recession, not going to be in a recession, that sort of thing. Where do you see the risk playing a role in the corporate bond side, particularly private credit and high yield?
Well, I think high yield, given it's a mark-to-market market, is where we came from. In very recent history, high yield spreads were tight from a historical perspective and weren't offering much in the way of cushion. I think there's the possibility there that's we see some widening again. That's much like that's the growth component similar to public equities, and we're going to see corporate earnings. Those tend to be public market players. Pressure on corporate earnings with a slowdown in the economy could pressure spreads. The ballast of that is that obviously it has a duration component to it too that's going to offset potential spread widening. But it would be hard to argue that we'd see a significant tightening. IG will trade a little different than high yield, and Brian can add color there. But I would expect that if we see additional economic weakness, tariff related or other, you're likely to see pressure on, especially on high yield spreads.
Yeah, we would echo that same sentiment that Steve outlined. Essentially, spreads have just still remain a bit tight, and so we watch spreads, and when we see them extend out, then to the question about risk return trade-off, that's where we start to see. The steady allocation to high yield is good in your portfolio, along with specialty credit for sure. But in terms of just A versus B, when spreads widen out, is when we would see that become even more attractive. But they've been tight.
Yeah, in our construction in that specialty credit bucket, which again is high yield, public bonds, loans, and private credit. We've opted and we've talked about. We tend on the public side in high yield. I think we probably have a bit more of a conservative management approach to the public high yields because we're looking for more alpha generation out of the private side. I think if we think about holistically the risk return profile of that portfolio, we're not looking for significant distress positioning. there may be an opportunity, and Anthony and Brian and I have talked about, again, we kind of do a what if scenario analysis. If things get really weak, is there an opportunity in distressed credit? And there might be. And so we need to look at ways to take advantage of that. But traditionally, our positioning has been more what I would call a conservative high yield, given that we have, additional alpha generation capacity and kind of that private credit allocation. If no additional questions, we go to page 60. Anthony is actually on a manager visit today, so I'll cover some of his asset classes. Real estate markets and sentiment have continued to rebound, with the open-end diversified core equity index posting a second consecutive positive quarter after 2 years of declines. This rebound in sentiment was also reflected in transaction volumes across all sectors, which have started to climb again from the trough reached in late 2023. The real estate portfolio posted a return of 1.61% for the quarter, outpacing the benchmark's 96 basis point return. The real return portfolio performed well during the quarter as expected, posting a return of 2.85% and outperforming the benchmark's return of 1.86%. The portfolio's largest allocation is our MLP investment. It gained 6.8% during the quarter, and it has returned over 26% annualized over the last 3 years. Additionally, the portfolio's farmland mandate was funded in the fourth quarter of 2024 and returned 3.1% during the first quarter. The portfolio's inland marine manager returned 1.4% for the fourth quarter and 8.2% for the full year. Again, a lot of the alternative asset classes are on a quarter delay in return, so I know it's a bit of a disconnect there, but Anthony's done a good job here of highlighting which are which, so we get returns on a quarter lag basis. Struggles continued in the private equity market as volumes of realized exits has remained well below the 2021 levels. We've talked about this several times. Higher interest rates are negatively impacting the buyout math and headwinds from broader market uncertainties driven by tariffs. The number of portfolio companies that private equity firms are waiting to sell hit another record high in 2024, nearing 30,000. So there's a significant backlog of companies that are held by private equity that are waiting to be realized. The private equity portfolio produced a return of 1.3% for the quarter, trailing the benchmark's return of 2.8%. Performance relative to the public market benchmark has continued to lag due to the robust equity market that gained 25% during 2024. Page 64. Thank you. Across portfolios, the largest contributor to our outperformance during the quarter was the strong relative performance in the specialty credit portfolio, as managers produced positive excess performance across mandates. The real return, public equity, and real estate portfolios all outperformed their benchmarks and contributed positively to performance. The largest driver of underperformance was the private equities portfolio's underperformance relative to its public equity benchmark. The overweight to public equity was also a modest detractor from overall performance during the quarter. It's also noted on these slides that the underweight to private equity is reflected as a detractor from relative performance. That's also related to that mismatch with the public equity benchmark. As we've talked about in the past, we've had several conversations. We're working with Wilshire, discussing alternatives, both from a benchmarking standpoint and alignment with our private equity portfolio relative to a benchmark, as well as some potential enhancements to reporting that may complement a change or an additional benchmark that we can use in our private equity portfolio to really provide more transparency and a better sense to trustees of how that portfolio is doing. As we've talked about, in significantly running markets up or down in public equity, the private equity benchmark is going to lag, can look good at times or bad at times, simply based on that mismatch in comparison to a public equity benchmark. So I think Wilshire has a couple of takeaways from our last conversation, providing some examples and some peer data as to what other of their clients are doing, as well as some sample reports that we might be able to utilize kind of as enhanced reporting to private equity portfolios performance. Page 75, please. Always some of our favorite Wilshire slides. From a pure universe perspective, all of the portfolios have performed well, producing top decile or near top quartile performance over the reported 1, 3, and 5-year periods. Over that same period, the portfolios have all produced top decile or just outside of top decile Sharpe ratios or risk-adjusted performance, really demonstrating the efficiency of their construction and management. So again, across portfolios, we like to highlight that section on the far right, and all of the portfolios perform well in Wilshire's peer universe. Page 80, please. As of the end of the quarter, all asset classes for each portfolio were within the IPS specified range, with the majority of positioning within 1% of the respective target allocation. Again, that goes back a little bit to Wilshire's comment as well, is that, you know, in market volatility, you know, I think it without being able to really develop a thought or a view as to outperformance of certain asset classes, I think we're trying to stick close to our targets. You know, that is our strategic asset allocation. You know, during the quarter, we did reduce the overall overweight to global public equities. In addition, we rebalanced the U.S. and non-U.S. exposures. As you see on the charts, we remain modestly overweight to public equities as the offset to the underweight in the other component of that growth allocation, private equity. We talked about here, I got the comment already, we remain neutral in core fixed income. Yields have remained really volatile. 10 years traded in an 80 basis point range year to date. So elevated volatility in yields, duration, we're staying close to home. In the real return asset class, allocations continue to move closer towards their targets, and that's as managers have called capital, including the farmland mandate that was fully funded, and over half of the railcar leasing allocation was called last quarter. The remainder of CERS's original 2023 commitment to the inland marine manager, plus the incremental additional allocation made recently, are scheduled to be deployed by the end of this quarter. So again, we'll move closer towards that real return asset class target. Since the end of the quarter, volatility has picked up. Again, volatility is going to be the theme right now, with sentiment-driven sell-offs and rallies based on headlines and evolving narratives. Wilshire hit on a couple of this, but the S&P, and I think this is as of yesterday, we're relatively flat today, but the S&P is up 15% since its low in early April, and that's one of the biggest rallies ever for the index, but it's still lower than it was 6 months ago and from the close on the day after the election. After the startling declines in consumer confidence that bottomed in April with tariffs dominating the news, as Wilshire mentioned, the conference board just reported the biggest monthly leap of confidence since 2009, excuse me. The April jobs report was relatively muted, indicating the labor market is still in good condition. Non-farm payrolls increased to 177,000, which exceeded expectations. April CPI report came in softer than expected, suggesting that businesses have been slow to pass on tariff-related costs to consumers. Specifically, the headline CPI rose 20 basis points month over month and 2.3% year over year, while core rose 20 basis points month over month and 2.8 year over year. At its May meeting, the FOMC voted to leave the Fed funds rate unchanged at 4.25 to 4.5 for the third consecutive meeting. And that's despite some signs of policy-induced weakness. The Fed remains committed to its wait-and-see approach and is in no hurry to make meaningful adjustments to policy until the ultimate form and impact of tariff policies becomes clearer. As I mentioned earlier, Moody's downgraded the U.S. from AAA to AA1. Now, they were the last major credit rating agency to do so, following S&P and Fitch's downgrade in 2011 and 2023. Specifically, Moody's cited the increase in government debt and rise in interest costs as the reasons for the adjustments, but didn't have elevated concerns about the U.S. economy broadly. Looking forward, tariffs will continue to challenge economic growth while putting upward pressure on inflation. While we think the recession risks eased somewhat following the most recent de-escalation in tariffs between the U.S. and China, market volatility will remain elevated really until policy uncertainty turns into policy clarity, which could take a significant amount of time. Slowing economic growth could weigh on corporate earnings. As we talked about, that could pressure both spreads and high yield as well as public equities. Fixed income continues to offer attractive levels of income and protection against an economic downturn. I think we've continued to rebalance and ensure that we're at targets. Potentially could see us go a little bit beyond targets in the core fixed income space. I think that's, again, attractive yields all in at this point. It offers a nice ballast, as Wilshire mentioned, as well as there's significantly more cushion than there was certainly in the ZIRP world. The ongoing equity market rotation that Joe talked about should present opportunities in sectors outside of tech, which has been the dominant theme for the last couple of years. I think that is a good opportunity for active managers to produce alpha. April performance should be finalized soon. Portfolios are up about 75 to 100 basis points for the month. Preliminary month-to-date performance for May has the portfolios up 2.5% to 3%. The other updates from the Office of Investments, we did have a hire. So he's going to be starting on June 23rd as the Senior Investment Analyst. We're excited to have him on board and expect he will be able to hit the ground running and contribute to a number of initiatives we have in progress. So we can't wait for him to start. The private equity position, we have not made progress on. We are recruiting for a senior level individual with extensive private equity experience. The biggest impediments identified by candidates include kind of our comp structure and the governance structure. And we were likely, the discussion is I think we're going to revisit that position, especially in light of hiring that senior investment analyst, and we'll probably be reposting the position as more of a generalist for alternative asset classes, so working across all of our asset classes. Again, that's consistent with the approach we've talked about, that's de-siloing from asset classes and kind of having more of a collaborative investment office. After a significant amount of work by KPPA staff, legal, and BNY, for the first time ever, investments have been papered in the CERS pensions name. Obviously, that we weren't able to achieve that for the insurance assets, as we still need both something enacted by statute as well as from an IRS determination standpoint. So I think that's still some time away, but we're happy to report that for the first time ever, assets are papered in CRS's pensions name. I did want to provide an update on Bay Hills. As you may be aware, the GP for Bay Hills funds has officially been removed and a liquidating person has been appointed. We've been working with Marty and her team to ensure that everything is in place for a smooth transition and ongoing management and operations of the funds. And importantly, following the reconciliation process, approximately $17 million that have been sitting in uninvested cash will be transferred to the portfolios. And longer term, we're evaluating whether the investments in the funds can be transferred in kind directly to the portfolios to be managed in-house by KPPA staff, which would further reduce the overall fees for the investments. I'll pause there for any questions.
Anybody have any questions for Steve? Okay. Steve, I think we're ready for your quarterly investment budget update.
Sure. Page 113, please. And this was the update that was presented to the Finance Committee last week. Page forward, please. Thank you. Through the first 9 months of fiscal 2025, realized expenses were in line with the budget, with a total of $8.9 million, or 71% of the budget spent year to date. I would note in the contractual service category, the outliers are that Mercer Insight and the new private markets consultant line items. Mercer Insight is a timing issue with only 2 quarters of fees being reflected as paid so far this year. And that was actually caught up this week. So we'll see by next quarter's reporting, we'll see we're in line with what has been budgeted. And while we had originally intended to do an RFP for a new private markets consultant during fiscal 2025, that project has been delayed, and we expect to complete that during fiscal 2026. As we've seen in the past, the legal and auditing services expenses are notoriously difficult to budget, as the realized expenses are based on litigation activity, which is often outside of KPA's control. While there's been significant variance at the individual line item level based on specific litigation activity, the overall legal expenses incurred are in line with the total budgeted. So great job by Michael and his team in forecasting and budgeting. And while we expect litigation activity and related expenses to remain elevated, given the resolution in certain matters, we will be proposing a reduction of about a little over $1 million in overall legal expenses for fiscal 2026. Page 117, please. Thank you. At the pension level, fiscal year to date, total investment fees and expenses have been $23.5 million or 23% higher than for the same period last year, while total assets have risen 8% over the same period. The notable increases include the $3 million increase in administrative expenses, $5.5 million in real return, which was driven by the increase in the allocation, as well as performance fees, $7.5 million in real estate, largely due to the reversal of the negative performance fee accrual, as well as an increase in overall expenses, and a $3.8 million increase in the overall specialty credit fees and expenses, and that was based on an increase in both assets as well as performance fees. As I noted in the Finance Committee meeting, the public asset class may look a little off with a larger reported fee and a smaller reported asset size, but that's really just a timing issue. For the 9-month period ending March 31st, the average monthly market value for 2024 was $7.98 billion, while it was $8.67 billion for 2025. So that really just has to do with rebalancing activity, the AUM over that 9-month period through March 31st. I would also highlight that the systems continue to benefit from the reduction in fees in the core fixed income asset class as a result of managing a part of that portfolio internally. A 12% increase in management fees year over year, while assets have increased 33%, and a 17% or $300,000 reduction in management fees since 2021, while assets have increased by over $1.1 billion or 50%. Page 119, please. And again, while the last report was at the trust level, page 119 and 120 break out the fees by asset class specifically for the CRS pension and insurance portfolios. And while I would note that the overall fee rates are consistent with the broader pension portfolio, the CRS fee rates are modestly higher for certain asset classes based on individual asset and manager allocations. The two notable that stood out to me were the private equity. CRS manager fee rate is 44 basis points, while the pension is noted at 38. That largely has to do with a number of the K portfolios were not investing for a period of time in private equity, so they have legacy older investments that aren't feeing currently, that are beyond their fee periods, while C still has some of those mandates that are in the feeing period. Additionally, real estate, the CRS manager fee rate is 81 basis points. Overall, the pension is 77. That's consistent with the difference in allocation and manager composition within that asset class. That's all I had. Happy to take any questions.
Any questions for Steve? Okay, hearing none. Steve, I appreciate your time, and Wilshire, you guys did a great job as always. At this point, I think we're ready to move on to the compliance officer's report. Ms. Carrie Bass.
Good afternoon. Nice to see you all. Sandy, we'll take it to slide 123, please. We're going to start out by looking at the investment guidelines in the CERS investment policy statement and other policies. Next slide, please, Sandy. As you can see, all the guidelines were noted to be in compliance during the quarter ending March 31st, 2025. Next slide, please. So there were no exceptions noted this time around. We'll skip to slide 127. As you've previously seen in your materials, all asset classes were in range during the quarter ending March 31st, 2025, so there are no exceptions to report. And then we'll skip again to slide 129. You've been provided the quarterly proxy report for this past quarter in your material, and I can confirm that the quarterly proxy reports are also located on the KPPA's website in compliance with statute. And then we'll finally, I'll wrap up with slide 131. I just wanted to provide a little brief information about the compliance officer independence, specifically relating to the quarterly compliance report. In preparing these reports, I rely on neutral third-party sources. My process and my reviews are, of course, subject to internal audit, like all processes here at the KPPA. Essentially, I consider my direct line of report to be to this committee if there were any major compliance issues. That's not currently documented, but it might be something we could consider documenting in a future IPS or other policy review. That's totally up to you. And the KPPA continues to look towards bringing my position outside of the Office of Investment to ensure independence. Does anybody have any questions for me today?
Carrie, I don't have any questions on your report. I do have a question that hadn't had anybody to ask the question to until now.
Okay, well, let's see if I can help answer it.
I'll put it in context. Coming from my side of the industry, one of the things that I get overseen by is any brokerage accounts or anything that I have are reported and monitored.
Mm-hmm.
Do we have anything in place like that for our investment office, much as for that matter, even our trustees?
The CERS board does have a security trading policy that covers personal trading accounts. That policy hasn't really been monitored for a little bit of time. That was noted in a recent internal audit finding. I've researched that policy, its history, compared it to other public pension plans, looked through the legal aspects of why we have that policy in the first place for CERS. And I think it could use a little bit of a facelift, a little bit of some clarifying information. So I'm hoping to work with Mr. Owen to bring a revised draft to the full CERS board. And also that draft would include specific requirements for me to report on compliance to this committee. If or the board, either one, again, totally up to you. I will be talking about this briefly as well at the KPP Audit Committee tomorrow morning at 10 a.m., which will be on Facebook for those who aren't on that KPP Audit Committee. As I said earlier, there was an internal audit finding that we weren't monitoring and reporting compliance with that CERS securities trading policy.
Mr. Chair, if I might.
Sure.
Carrie, I look forward to getting an opportunity to work with you on the security trading policy. Though I would say it's a bit of a misnomer to characterize that as a CERS policy. That when you look at that policy, it's clear that the enforcement of that policy has always been at the KPPA level. At the board level, we don't have a compliance officer. And if you look at the policy as it's written today, it clearly states that it's the compliance officer's responsibility. So when you say that it hasn't been monitored for a while, I would simply say that's not a function of the C board. That's a function of the responsibility of the person identified in the policy. So I look forward to working with you on it. I don't think that, and I say this for the board's respect, I don't think that when that policy is finished that you'll see CERS in front of it, because I don't think it's a policy that can be driven and are enforced by the CERS board. Thank you, Mr. Chair.
Okay, thank you. Carrie, if it'll help you at all, the way I get monitored, my broker dealer subscribes to a service by an outside vendor who monitors those accounts, and then things get flagged. I don't know if that's something that you're looking at or thinking about, but I'll be happy to get you that vendor's information.
That would be great if you wouldn't mind sending that to me. I did note in my review of other public pension plan personal trading policies that many of them do use an outside service. So that's something that we can certainly look into.
Okay. I know us as trustees, we have to file a financial report with the ethics commission every year. Does that pertain to any of KPPA's staff? I didn't know how that worked.
Other KPP staff are subject to the Executive Branch Ethics Commission filings. For example, I myself, in my current position, have to make the same filings as trustees, but not all positions have to do those filings for the Executive Branch Ethics Committee.
It's all
the issue with kind of relying on those for the personal trading policy. You might remember Mr. Cheatham from doing these executive branch ethics filings every year. So it doesn't. There's not a total transparency with those filings of the trades that are happening within an individual account.
Yeah, only way it gets flagged is Steve reports a $10 million increase to his net worth, right?
That's right. That's right. When he buys a private island, we'll know something has gone awry.
All right.
Just to clarify, Mr. Cheatham, all the investment staff subject to those executive ethics commission things. So.
And financial disclosure, yes.
Yeah. It's all not across state government. So I had to do it in my former role as an executive director, and I have to do it in the current role. It's a lot of individuals, but it doesn't necessarily work for the law. And as Carrie said, we would solicit all input, because when I came in and read it, I thought it'd be very difficult to do advisory and brokerage service the way it was currently written. And so any input outside, thank you, Mr. Cheatham, outside services, we're looking at a broad group to provide input, because we do not want it to hamper your day job. And as it's written, I believe it would.
Yeah. Okay. All right. Well, that's all the questions I had. Bill, Tommy, you all have questions for Carrie? Okay. Hearing none, unless somebody has new business they'd like to bring up. If not, I'll entertain a motion that we adjourn. I don't think there's anything else on the agenda, is there? Nope. Okay.
I make a motion.
I say
Second by Bill. All in favor?
aye.
I appreciate your all's time today, and have a good weekend.